U.S. economic crisis, its history, and warning signs. Protect yourself from the next. A U.S. economic crisis will be a violent and sudden upheaval anywhere in the economy. This could be a stock market crash, an increase in inflation or unemployment, or a series of bank failures. Although they do not always cause stagnation, they have serious effects. The United States seems to experience an economic crisis every 10 years. They are difficult to eliminate because the reasons are different. However, the results are always the same. These include high unemployment, imminent bank collapse, and economic contraction. These are all symptoms of a recession. However, if handled at a time of financial crisis, it does not necessarily lead to recession. Economic crisis history. These 6 crises help you recognize the warning signs of the next one. You will find that the government's action prevented a complete economic collapse and made things worse. The Great Depression of 1929, the first warning was stock market bubble during the Roaring '20s. Smart investors could start making a profit in the summer of 1929. In October, the 1929 stock market crash triggered the Depression. It erased the lives of millions of people. It was not the last time a stock market crash caused a recession. One of the causes of depression was Dust Bowl. 10 years of drought contributed to famine and homelessness. Another reason was that the Federal Reserve was using a tightening monetary policy. It wanted to preserve the value of the dollar, then it was based on the gold standard. Fed's policies created deflation. According to the Bureau of Labor Statistics, the Consumer Price Index dropped 27% between November 1929 and March 1933. The effects of the Great Depression devastated America for 10 years. Housing prices fell 67%, 0.3 GDP fell 29%, at its lowest level in 1933, for fall in prices drove many firms into bankruptcy. The unemployment rate rose to 25% in 1933. Huge government spending for the New Deal and World War II ended the Depression. However, this raised the debt to GDP ratio to a record 113%. If climate change creates another major drought, there could be another Great Depression. In 1970s stagflation, the 1973 OPEC oil embargo marked the beginning of this crisis. The government response turned it into a full-fledged double-digit inflation and recession crisis. According to the BEA, the economy shrank minus 4.8% in the first quarter of 1975. In 1975, unemployment peaked at 9%. Prices soared after President Nixon unwound the dollar from the gold standard. It froze wages and prices to reduce inflation. This has caused businesses to lay off workers who were unable to lower wages or raise prices. Fed Chairman Powell Volcker used a tight monetary policy to end the crisis. It raised interest rates to suppress inflation. The warning signals for the crisis were statements made by OPEC and Nixon's proposed destructive actions. 1981 recession, high interest rates to contain inflation, created the worst recession since the Great Depression. The economy contracted in 6 of the 12 quarters of the crisis. The worst was minus 8% in the second quarter of 1980. 12 unemployment was over 10% for 10 months. In November and December 1982, it rose to 10.8%, the highest level in any modern recession. The crisis created a recession in July 1990. In fourth quarter, the economy shrank by minus 3.6%. Unemployment peaked at 7.8% in June 1992. The next bailout added $124 billion to national debt. This is one of the worst explosions and falls since 1980. 9/11 attacks. 4 terrorist attacks occurred on September 11, 2001. They stopped air traffic. 2 attacks that destroyed the World Trade Towers closed the New York Stock Exchange until 17 September. When it reopened, the Dow dropped 684.81 points. No warning has been issued for the general public. The crisis pushed the US back into 2001 recession and extended it until 2003. The economy shrank 1.1% in the quarter and 1.7% in the third quarter. Unemployment peaked at 6.3% in June 2003. Some of these were not because of the attacks themselves. It was due to uncertainty about whether the United States would go to war. The resulting war on terror added $2 trillion to national debt. 2008 financial crisis. The financial crisis was worse than any other crisis except the Depression. The first warning came in 2006 when house prices began to fall and mortgage defaults began to rise. The Fed and most analysts ignored this. They welcomed a slowdown in the overheated housing market. In 2007, the subprime mortgage crisis broke out. Lenders had allowed a large number of individuals to take out high-interest mortgages. When they went into default, banks sought credit default swaps. This drove insurance companies such as the American International Group into bankruptcy. By midsummer, the banks stopped lending. In 2008, the Fed stepped in to keep Bear Stearns and AIG afloat. The U.S. Treasury nationalized mortgage guarantors, Fannie Mae and Freddie Mac, to keep the housing market afloat. However, they could not help the investment bank Lehman Brothers. His bankruptcy caused a global banking panic. Frightened companies withdrew a record $169 billion in money market accounts. If the money markets had collapsed, companies would lose access to the cash they needed to operate. The Dow fell 777.68 points, its worst one-day drop. The economy shrank -2.3% in the first quarter, -2.1% in the third quarter, and -8.4% in the fourth quarter. It contracted by -4.4% in the first quarter of 2009 and -0.6% in the second quarter. Congress approved a $700 billion bank rescue package to restore confidence and prevent collapse. Obama's economic stimulus package pumped $787 billion into the economy. Is the United States on the verge of another crisis? Modern U.S. economic history predicts that the next crisis will occur between 2019 and 2021. It doesn't tell you where this will come from, what the outcome will be, and how to defend yourself. What will protect you in previous crisis might be the worst thing to do in the next crisis. You should pay attention to the warning signals. The first sign is an asset bubble. It was housing prices in 2008. It was high-tech stock market prices in 2001. It was on the stock market in 1929, often accompanied by the feeling that by investing in this asset class, everyone get rich beyond their wildest dreams. President Ronald Reagan cut taxes and increased spending to end it. This doubled the national debt during his 8-year tenure. 1989 savings and credit crisis. Charles Keaton and other unethical bankers created this crisis. They raised capital by using federally insured deposits for risky real estate investments. 5 senators accepted campaign contributions in exchange for destroying the bank regulator so that he could not investigate criminal activities. The public was not warned because banks lied about business deals. The crisis resulted in the closure of about half of all savings and credit banks in the United States. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.